Two of the most popular ETF choices are SCHD and VTI, but they couldn't be more different. One is built for dividends and reliable income, the other is designed to capture the growth of the entire U.S. stock market. So which one actually makes you more money? And maybe even more importantly, which one fits your investment style best? Let's start with VTI first because it's the bigger umbrella. VTI is the Vanguard Total Stock Market ETF, launched in 1992, and its job is straightforward: own the entire U.S. stock market. It tracks the CRSP U.S. Total Market Index, which basically means nearly 100% of investable American stocks, over 3,500 companies. Up top, you've got NVIDIA, Microsoft, Apple, Amazon, Tesla, Meta, Broadcom, and Alphabet. The top 10 together are about 33.17% of the fund. Sector-wise, it's tilted toward technology at 33.12%, then financials at 13.67%, and consumer cyclical at around 10.62%. Think of it as a miniature version of the whole U.S. economy in one ticker, designed to let you invest in America's long-term growth without micromanaging anything. SCHD, meanwhile, is different by design. It is the Schwab U.S. Dividend Equity ETF, launched in 2011. Instead of owning thousands of names, it carefully screens for financially solid companies that pay and grow dividends. SCHD follows the Dow Jones U.S. Dividend 100 Index, which screens for companies that not only pay dividends but also look strong enough to keep paying and even grow those dividends over time. To make the cut, a company has to have a history of paying dividends for at least 10 straight years, solid fundamentals like good cash flow and manageable debt, and a track record of financial strength. Out of the whole U.S. market, just over 100 stocks qualify, and SCHD holds 103 of them. At the top, you'll see AbbVie, Chevron, Home Depot, PepsiCo, Cisco, Merck, Verizon, and Lockheed Martin. Here, the top 10 make up more than 41.2% of the fund, so a smaller group of companies moves the results more. Sector tilts lean into resilience and cash flow. Energy at 19.77%, consumer defensive at 18.68%, and healthcare at 15.88%. So VTI spreads its bets across thousands of stocks, giving you broad safety through diversification. SCHD concentrates its bets on fewer companies, trading breadth for quality and income consistency. But here's the thing, knowing what's inside these funds only gets you halfway. The real question is, who are they actually built for? Let's start with the SCHD type of investor. This is someone who loves the idea of getting paid along the way. Maybe you're closer to retirement, maybe you want to get paid higher when you retire, or maybe you like the comfort of seeing dividends hit your account every quarter. Now flip it over to the VTI type of investor. This is usually someone who doesn't want to overthink their portfolio. They just want to own the entire U.S. market, set it, forget it, and trust that over time the economy grows. You'll often see younger investors leaning toward VTI because they've got decades ahead of them. They don't mind waiting because compounding does all the heavy lifting for them. It's a simple strategy: hold everything, spread out the risk, and let innovation, technology, and the natural growth of businesses push your portfolio higher. So which mindset do you identify with? Do you want a steady income now, or do you want to maximize long-term growth? That's the core of the decision, because SCHD and VTI aren't competing to be the same thing. They're two very different tools designed for two very different types of investors. With that in mind, let's dive deeper into how their strategies actually play out in terms of dividends and growth. Let's start again with SCHD. This fund is built around dividends. Today, SCHD offers a dividend yield of about 3.75%, which is well above the average ETF payout of roughly 2.68%. On a $100,000 investment, that works out to about $3,750 per year in dividend income right from the start. But the real magic isn't just the current yield, it's the growth. Over the past decade, SCHD's dividends have grown at an average rate of 10.77% per year, and the fund has logged 13 consecutive years of dividend increases. For income-focused investors, that is huge. It means not only do you get paid today, but your paycheck keeps rising over time. That's why people call it a money tree. It's designed to produce fruit and grow more branches as you go. Now, VTI is completely different. Its dividend yield is just 1.13%, which means a $100,000 investment would only make about $1,130 a year in dividends. Its dividend growth is also lower, about 6.36% annually, and it's only managed 4 years of consecutive increases. Clearly, dividends aren't the focus here with VTI. Instead, VTI's strategy is all about capital appreciation, which we'll see in a couple of minutes. When the stock market grows, especially tech-heavy sectors, VTI takes full advantage of that wave, often outpacing dividend-focused funds in pure price growth. But strategies on paper are only half the story. What really matters is what it feels like to hold these ETFs through market ups and downs. Also, stick around because in a couple of minutes, I'll show you and John a side-by-side comparison of what happens if you put $100,000 into each ETF. We'll see which one could add an extra $800,000 to your portfolio and which one could pay you more than $20,000 every single month in dividend income. But first, let's see the risk side of both ETFs. Take SCHD first. Its standard deviation, a measure of how much returns swing up and down, sits at about 14.09, with annualized volatility around 16%. In plain English, SCHD can bounce around, but it's not extreme compared to the broader market. Because it's concentrated with the top 10 holdings making up over 41% of the fund, certain companies like AbbVie or Chevron can really move the needle. That's more concentration risk than VTI, but SCHD's dividend cushion makes those bumps feel less painful. Even when share prices dip, you're still collecting steady cash. Liquidity isn't an issue either. With over $71 billion in assets and nearly 16 million shares traded daily, buying or selling SCHD is easy. Now compare that with VTI. Its standard deviation is a touch lower at 13.52, but the annualized volatility is higher at 19.35%, largely because of its exposure to technology stocks. America's economy is heavily tilted toward the tech side right now. So when tech rallies, VTI goes up, but when tech crashes, the ride gets rough. The difference is that VTI's portfolio is spread across more than 3,500 companies, and its top 10 holdings only make up about 33%, which reduces concentration risk. Liquidity is off the charts, with nearly $2 trillion in assets and over $1 billion traded daily. VTI is one of the most liquid ETFs on the planet. So here's the difference in the ride. SCHD feels steadier with dividends acting like shock absorbers, while VTI feels more like a roller coaster with higher highs, sharper drops, but with enormous long-term potential. So when you line them up side by side, the recent numbers tell a pretty fascinating story. Over the past year, SCHD hit a bit of a rough patch, delivering a negative 3.74% return. It wasn't catastrophic, but it was a dip. VTI, on the other hand, had a strong run with a positive 16.91% return. That's a striking difference in such a short time frame. And it shows how VTI's exposure to growth-heavy sectors like technology can give it a boost in favorable market conditions. Looking at the past 3 years, SCHD came in with an 18.17% gain. That's steady, positive growth, especially for a dividend-focused fund that emphasizes stability. But VTI again left it in the dust, climbing an impressive 74.73%. Now stretch it to 5 years. SCHD posted about 48.26%, which is very respectable. But once again, VTI nearly doubled, delivering a 95.52% gain. The pattern is clear. When you're looking strictly at price growth, VTI has consistently outpaced SCHD across short, medium, and longer timelines. But here's the part that these raw numbers miss. SCHD's investors weren't just getting growth from price appreciation, they were also pocketing dividends the entire way. That stream of income doesn't show up in these simple return charts, but in real life, it makes a huge difference, especially when you reinvest it. It's money you can reinvest or money you can actually spend while still holding on to the fund. VTI doesn't put much focus there, which is why comparing only the price returns is a little unfair. But history is only part of the picture. What really excites investors are the future projections, and that's where the comparison gets even more interesting. We'll keep John's setup simple so it's easy to follow. Starting principal is $100,000. Annual contribution is 0. Dividend reinvestment is on, and the dividend tax rate is assumed to be 0 because John is investing through his Roth IRA in this example model. To make this fair, let's use the numbers these funds have actually delivered on average in the past. For VTI, that means a dividend yield of about 1.1%, dividend growth of about 6%, and share price growth of roughly 12.6% a year. For SCHD, we'll go with a starting yield closer to 3.7%, dividend growth at nearly 11%, and price appreciation around 8.6% a year. Now, none of this is a promise about the future. Markets don't work like that, but using these averages gives us a solid way to compare them side by side, allowing us to compare apples to apples. The question is, which one pulls ahead when we let them run for 10, 20, or even 30 years? Let's start with VTI. After the first year, John's portfolio is projected to be valued at around $113,730. By year 5, it's projected at about $189,166. At the 10-year mark, the projection shows roughly $353,532. Fast forward 20 years and the portfolio is projected to clear $1.2 million. And by year 30, John's investment is projected to be valued at about $4,033,788. At that point, the yearly dividend payout could be around $6,239 or about $520 per month. Breaking down that projection, about $3.84 million of the growth is expected to come from pure price appreciation, while roughly $92,000 would come from reinvested dividends. That's VTI's story in one line. The growth is overwhelmingly driven by capital appreciation. Now compare that with SCHD. After the first year, John's portfolio is projected to be valued at about $112,370. By year 5, the projection rises to about $180,481. At the 10-year mark, it grows to roughly $332,143. By year 20, the portfolio is projected to pass $1.2 million, but the real story shows up at the 30-year mark when SCHD is projected to reach about $4,843,633, actually surpassing VTI in total value. Here's where SCHD really separates itself. By year 30, it's projected to pay out around $291,254 a year in dividends. That's more than $24,000 every single month. The total value added comes in at about $4.74 million, with roughly $2.77 million from capital appreciation and nearly $1.97 million from reinvested dividends, an even distribution between dividends and capital appreciation. And it beats VTI both in terms of value added and dividend income.